looking at the latest news, the consolidating trends, and all these conflicting sell signals mixed with some really aggressive buy ratings, you sort of have to ask yourself a seriously compelling question.
Right.
Is Kraken Robotics, ticker symbol KRKNF, this undervalued submerged treasure hiding in plain sight? Or is it basically an overvalued value trap just waiting to sink retail investors?
I mean, it operates as the ultimate Rorschach test in the current market environment. Two different investors can look at the exact same financial data, the exact same technical charts, and walk away with completely inverted realities.
Exactly.
It all depends on, their risk tolerance and their time horizon.
And you brought us an incredibly dense stack of sources today to help figure out which of those realities actually holds more weight.
Oh, yeah, it's a lot to get through.
We're looking at fresh financial statements, technical analysis charts, and a whole slew of analyst ratings, all current as of today, April 17, 2026. So our mission for this deep dive is to cut through the noise of Kraken's recent transition for you. Because, well, this company has officially graduated from a microcap startup to a mid-cap defense player.
Which is a huge leap.
Right. They're now carrying a market cap floating right between $1.97 and $1.99 billion.
And entering that mid-cap weight class, I mean, it fundamentally alters how institutional algorithms and these large-scale asset managers judge a company's balance sheet.
Yeah.
The margin of error they enjoyed when they were just the speculative microcap is completely gone now.
Oh, for sure. But before we unpack those new expectations, I do need to state our crucial disclaimer.
Always important.
Yes, this deep dive into your sources is purely for educational and entertainment purposes. We are analyzing data and market trends, but this does not constitute financial advice. Always consult a professional and, do your own research.
Absolutely.
Also, if you enjoy this deep dive, please like the video, subscribe to our channel, and compulsory leave your comments and feedback below. This stock sparks a massive debate, and we want to hear where you stand.
Definitely. But to truly evaluate the health of this new mid-cap valuation, we really have to start with the underlying business engine.
Okay, let's unpack this, because the numbers from their 2025 income statement are, well, they're staggering.
They really are.
They hit a record total revenue of $102.2 million. And they're aggressively guiding for 2026 revenue to land somewhere between $165 million and $175 million.
Which is massive year-over-year growth.
Right. And profitability-wise, the 2025 gross profit sat at $63.4 million, though net income came in at just $2.86 million, which leaves the EPS, the earnings per share, for the trailing 12 months at a microscopic 1 cent.
Yeah, and that gap between the top-line revenue and the bottom-line net income is honestly, it's where a lot of retail investors get super confused.
Yeah, they see the penny EPS and panic.
Exactly. But if you look at the adjusted EBITDA, which strips out the heavy depreciation costs associated with all their hardware, it paints a much clearer picture of their operational cash generation. Their adjusted EBITDA hit $25 million in 2025, and their guidance projects $40 to $50 million for 2026.
But we really can't analyze that 2026 guidance without addressing the elephant in the room.
The Covelya deal.
The $615 million acquisition of the Covelya Group. That deal completely reshaped their balance sheet. I mean, total assets nearly doubled.
Right.
Jumping from $162.6 million in 2024 to $313.7 million in 2025. And their total cash position also surged from $58.5 million to $120.5 million year over year.
Which leaves their working capital at a very healthy $171.6 million.
Exactly. So the balance sheet looks pretty robust on the surface, right?
On the surface, yes. But the critical metric for hyper-growth hardware companies, and we've talked about this before, is always the cash flow statement.
Okay, let's unpack this negative cash flow, because this is where the thesis gets really complicated.
Yeah, it does.
Operating cash flow for 2025 was actually negative $29.68 million.
Right.
And I sort of look at this the same way I look at a booming restaurant buying the building next door.
Oh, that's a good way to put it.
Right. Like, the cash leaves the wallet today, creating this terrifying short-term balance sheet, but it's physically necessary to seat more customers tomorrow.
Exactly.
Kraken spent $30.29 million in capital expenditures purely for manufacturing expansion.
And that restaurant analogy captures the structural necessity perfectly. Because in high-growth defense and subsea technology sectors, scaling requires intense upfront capital expenditure.
You have to build it first.
Right. A company literally cannot physically fulfill $175 million in future orders if their factory floor is only constrained to output $50 million worth of product.
Yeah, the math just doesn't work.
They have to build the physical capacity before they can book the revenue.
So the spending is a prerequisite for survival, but I imagine it drastically shrinks their margin of error if something goes wrong.
Oh, it eliminates their safety net entirely. I mean, if
Oh.
macro demand falters or if their newly expanded manufacturing lines hit some kind of production snag, that heavy cash burn rate transforms from a strategic investment into a fatal liability.
It becomes a massive anchor.
Exactly.
So, with that fundamental reality established, let's pivot and look at how the market is actually pricing all of this expansion right now.
Let's do it.
As of April 17, 2026, the stock closed at $6.43. It was down a fraction of a percent on the day, but up 30.68% year-to-date, and it's up over 280% on a one-year basis.
Wow. And a 280% run completely alters the psychology of the shareholder base.
It really does.
Early buyers get super defensive, they're desperate to protect their gains. Meanwhile, new buyers are totally paralyzed by the fear of catching the top of a cycle.
And the 52-week range really highlights the sheer volatility of that climb. It stretches from a low of $1.57 all the way up to a high of $8.13.
That is a massive spread.
Huge. And with an average daily volume of 1.15 million shares, the liquidity is certainly there. But when you look at the daily chart, the setup is showing classic consolidation.
Right, the stock is basically attempting to catch its breath and establish a new floor after that historic rally.
I want to push back on some of the technical jargon here, though, and dig into the mechanics of this consolidation. Because the charts are throwing out a maze of signals.
They really are.
We have key support established as $6.19, which is the 20-day simple moving average, and then another layer of support at $5.62, representing the Fibonacci 61.8% retracement level.
Right.
Above us, resistance sits at $6.79 near the upper Bollinger Band, and the absolute ceiling is that $8.1352 week high.
Yeah.
So my question is, if the stock is just violently ping-ponging between that $6.19 support and $6.79 resistance, aren't retail traders just getting chopped to pieces? It feels like a total trap for anyone trying to time a breakout.
Well, you're right. That's the primary danger of a sideways channel. Traders often buy near the resistance level anticipating the breakout, only to panic sell when the price naturally reverts back down to the support line.
Yeah, they buy high and sell low, basically.
Exactly. But what's fascinating here is how the short-term noise often masks the structural trend. Look, a 61.8% Fibonacci retracement level isn't just an arbitrary line on a chart.
Right.
It is a key mathematical zone where institutional algorithms frequently program their buy limits after a major run-up. It establishes a really firm base.
Okay, let's look at what the longer-term moving averages are telling us about that base. The 8-day SMA sits at $6.24, flashing a buy. The 50-day SMA at $6.30 just crossed a few days ago on April 16th, showing neutral to buy. But the real story seems to be the 200-day simple moving average, which is trailing way down at $4.46.
And that distance between the current price and that 200-day SMA is absolutely critical, because the 200-day smooths out nearly a year of price action. Its upward trajectory proves that the long-term bullish trend remains entirely intact, even amidst all this short-term daily chop.
That makes sense. We also have the momentum oscillators to factor in. The RSI is sitting at 52.8.
Right, the relative strength index. And a reading of 52.8 indicates absolute neutrality.
It's right in the middle.
Exactly. The asset is neither overbought to the point of exhaustion nor oversold to the point of capitulation. It is literally a stock holding its breath.
And the NANCD is showing a slight negative 0.02, though the sources mentioned some quantitative models picked up a positive divergence around April 14.
Yeah, the MACD tracking slightly below zero simply illustrates that the short-term momentum has temporarily decoupled from the long-term trend. The moving averages are tightening, which, historically precedes a pretty volatile breakout in either direction.
And this technical holding pattern perfectly sets the stage for the intense philosophical divide tearing through the market right now.
It really does.
With the bull case anchored in defense contracts and the bear case utterly terrified of the valuation multiples, investors are really being forced to pick a side. Is Kraken an undervalued gem or a catastrophic value trap?
Well, we can actually bypass the online rhetoric and look straight at the order flow to see where the actual capital is being deployed.
And the order flow data shows buyers heavily clustered in that $5.90 to $6.10 zone, establishing a very strong value area low.
Right.
But the moment the stock pushes above $6.80, selling pressure intensifies aggressively. The algorithms are clearly defending that upper boundary.
They are. But honestly, more revealing than the algorithmic boundaries is the behavior of the people actually running the company. Insider sentiment currently leans negative.
This is a huge point.
Yeah.
We have records showing senior officer Gregory Michael Reed dumped a significant tranche of shares way down in the $2.06 to $2.19 range back in mid-2025.
Yeah.
And as we look at the data from early 2026, there is an absolute drought of insider purchasing. I mean, I struggle to see how an investor can justify buying at $6.40 when the senior officers weren't even buying at $2.
Look, an insider selling isn't an automatic death sentence. Executives liquidate shares for taxes or, portfolio diversification all the time.
Fair enough.
But the total absence of new insider buying during what is supposedly a critical growth phase, that feeds directly into the bear thesis.
Let's lay out the opposing side, though, because the bulls have a very compelling argument rooted in real geopolitical realities.
They definitely do.
Kraken has already announced $87 million in product orders for early 2026. Plus, they have completely entrenched themselves as the lead supplier for defense technology giants like Anduril.
Which is a massive connection.
Huge. The protection of subsea cables and underwater energy pipelines has become an urgent, non-negotiable priority for global defense budgets right now. And Kraken provides the proprietary sensors making that protection possible.
They've established a legitimate strategic moat, and coupling that proprietary tech with their newly opened facility in Nova Scotia, which effectively doubled their manufacturing capacity, means they finally have the infrastructure to actually deliver on those massive government contracts.
The operational momentum is just undeniable.
Yeah.
But here's where it gets really interesting.
Okay.
The bearish argument, the thesis for a worst-case continuation lower, is entirely rooted in the mathematics of their valuation.
The multiple.
Yes. Kraken is currently trading at a PE ratio estimated between 643x and 900x. I honestly cannot comprehend how any financial analyst can look at a 600 times earnings multiple and argue with a straight face that the stock is undervalued.
Right, because a multiple of 643x essentially means investors are paying today for centuries of current earnings.
It's insane.
It demands that the company achieve flawless, exponential, and completely uninterrupted growth for the next decade just to justify its current price tag. It strips away any margin of safety for retail traders.
If they miss a single quarterly revenue target, that multiple becomes a lead weight.
Exactly. Which brings us right back to the most severe risk profile we talked about, that $615 million Covelya Group acquisition.
Right.
The bears argue that this deal introduces immense execution risk. Merging two hardware-intensive companies requires integrating completely disparate corporate cultures, untangling redundant IT systems, and syncing highly complex global supply chains.
It's a logistical nightmare.
If that integration process isn't executed flawlessly, those projected financial synergies will just evaporate. And that PE ratio will absolutely crush retail traders.
And beyond the execution risk, there is severe concentration risk. The bears correctly point out that Kraken relies on a very small handful of major defense contractors and government entities.
Yeah, that's a classic defense sector problem.
If a single federal budget gets delayed in legislative gridlock, or if a contract gets awarded to a competitor, Kraken absorbs an outsized financial blow.
Operating a high capex business with a concentrated customer base and a 600x PE ratio is basically the ultimate high-wire act. The upside is vast, sure, but the safety net has been completely removed.
So looking at these extreme conflicting realities, it feels like Wall Street is honestly just as confused as retail traders.
Oh, they are.
Let's look at how the professional analysts are trying to predict the outcome of this high-stakes tug-of-war.
The institutional ratings reflect the exact same paralysis we just saw in the technical charts.
The consensus rating officially sits at a hold, scoring at 2.33. Yet the average price target from those very same analysts is a lofty $11.13.
It's a huge contradiction.
Right. How does a firm slap a hold rating on a $6.43 stock while simultaneously predicting it will nearly double in value?
It exposes their internal risk management struggles. I mean, they mathematically model the upside based on the projected defense contracts and those Covelya synergies, which results in the $11 target.
Yeah.
But the portfolio managers are just too terrified of the downside volatility associated with a 600x multiple to actually formally recommend buying the stock at current levels.
And the recent actions from March and April 2026 really highlight that internal industry division. Zacks Research recently upgraded the stock to a hold. Desjardins took a more aggressive stance, upgrading them to a moderate buy.
But then you have ATB Cormark.
Exactly. ATB Cormark went the complete opposite direction, downgrading Kraken to a strong sell, heavily citing the exact valuation risks and multiple compression dangers we just analyzed.
It perfectly defines a battleground stock. But if we segment the outlook by time horizon, the quantitative models focused on the short term actually predict a 90% probability of an upward move in the coming days.
Really?
Yeah, driven by those momentum indicators that turn positive around April 10th. The immediate algorithmic pressure points up.
The long-term outlook, however, carries a heavy caveat. The analysts universally agree on the structural potential driven by global subsea infrastructure spending. But every single bullish report explicitly warns that the stock is priced to perfection.
And we know that price to perfection is basically the polite institutional phrasing for if this management team stumbles in execution by even a fraction of an inch, valuation will collapse.
So what does this all mean for your listening right now? Taking all of these sources together, the narrative really clarifies. Kraken Robotics is a company with undeniable operational momentum. They boast record-breaking revenues, a robust backlog of defense orders, expanded manufacturing capacity, and an incredibly deep strategic moat in a vital geopolitical sector.
Right.
They are undeniably executing their vision.
Right.
However, that operational success comes attached to a price tag, a valuation multiple that demands absolute perfection from their earnings reports for the foreseeable future.
Ultimately, the decision for an investor evaluating this research comes down to a really tough risk-weighting exercise.
Yeah.
You have to balance the secular tailwinds of defense sector spending against the severe, gravity-driven risks of holding a hyper-growth stock priced at over 600 times its current earnings.
That's a huge trade-off.
It requires choosing between the narrative of what the company will become and the mathematical reality of what the equity costs today.
It requires an iron stomach, honestly. We want you to take these metrics, evaluate the charts, and conduct your own rigorous due diligence. Keep challenging the consensus, whether you side with the bulls projecting an $11 breakout or the bears warning of a valuation collapse.
And as you process this data, consider one final variable. This raises an important question regarding their strategic moat.
Okay, what is it?
We establish how vital subsea infrastructure technology is in the current climate, but geopolitical priorities are notoriously fluid.
They change overnight.
Right. So if global defense budgets suddenly pivot away from the ocean floor to prioritize, say, aerospace or cyber warfare, does that $615 million Covelya acquisition suddenly become an anchor dragging Kraken down rather than the propeller pushing them forward?
Wow, a submerged treasure or a very expensive anchor.
It's a fascinating thought to leave on. Thank you for bringing us these sources, and thanks to everyone for diving deep with us today. Let us know what you think in the comments.